Hello and welcome back to another video. Today we will be covering two major concepts in basic financial literacy: inflation and interest. Over the several decades there has been an increase in the amount of young adults that struggle with finances due to poor education. In this video we will cover these two concepts and how they are interlinked. We will study the relationships between them and hope to bring more clarity to the subject. The market is dependent on many different factors that have great influence on future prospects. Of these many factors, the important ones to know revolve around the idea of supply and demand. The amount of a good or service that a producer is prepared and able to sell for a specific price is referred to as the supply. The law of supply holds that, all other things being equal, producers will be willing and able to supply more of a good or service if the price is higher, and vice versa. This is due to the fact that rising product prices make it more advantageous for producers to supply a product, thus they increase output. In contrast, when a product's price drops, producers could decide to scale back their output or shift their focus to something else with higher profit margins. Contrarily, demand describes the amount of a good or service that customers are willing and able to purchase at a specific price. The law of demand states that, all other things being equal, customers will be less eager and able to purchase a good or service the more expensive it is, and vice versa. This is due to the fact that as a product's price rises, buyers may decide to buy less of it or switch to alternative products that provide a better value for their money. On the other hand, as a product's price drops, customers could decide to purchase more of it since it becomes more accessible. The quantity and price at which a good or service is being equally supplied by producers and customers is known as the market equilibrium. This equilibrium is determined by the interaction of supply and demand. There is neither scarcity nor an oversupply of goods or services, and the price is stable when the market is in equilibrium. The idea of supply and demand can help to define both inflation and interest. Inflation is a long-term, steadily rising level of prices for most products and services across an economy. This implies that fewer goods and services may be purchased with the same amount of money as in the past. A number of things can contribute to inflation, including an increase in the money supply, which can result in more money competing with the same quantity of goods and services, or a decline in the availability of the same products and services, which can raise their costs. Inflation can also be caused by demand-side factors, such as a rise in investment or consumer expenditure. Pressures on inflation might also be brought on by changes in global commerce or natural disasters. An economy may benefit from some inflation, but too much inflation can be harmful. Increased expenses and decreased competitiveness for firms can result from high inflation, which can also cause uncertainty and lower confidence among investors and consumers. In extreme circumstances, hyperinflation can cause social unrest and economic instability. The central banks and government can control the inflation rate of an economy through many different actions. One major action can be the adjustment of interest rates. Interest rates are the fees that a borrower must pay to a lender in return for the usage of funds. In other terms, it is the expense of borrowing money. Interest rates can be divided into two categories: nominal and real. Nominal interest rates are those that lenders and borrowers quote and take inflation into account. Contrarily, real interest rates account for inflation and represent the genuine cost of borrowing or the true return on lending. Interest rates and inflation are closely correlated with one another. In general, high inflation is accompanied with high interest rates. In contrast, interest rates often remain low during periods of low inflation. This correlation between inflation and interest rates results from the gradual erosion of money's buying power caused by inflation. It costs more money to purchase the same amount of products and services as their prices rise. Lenders and investors will thus ask for higher interest rates to make up for the decline in purchasing power that will take place over the course of the loan or investment. An important part of this interaction is also played by central banks. Interest rates must be set by central banks in order to meet their objectives in terms of full employment, price stability, and economic growth. In order to decrease the demand for credit and slow the economy down when inflation is strong, central banks may raise interest rates. On the other hand, in times of low inflation, Central banks may lower interest rates to encourage borrowing and spending and accelerate economic expansion. The ideas behind inflation, interest and their relationship can be a daunting task to fully understand. Here we attempted to make it simple and still knowledgeable to the audience. We hope that this information can be used in your daily life and help you begin understanding the economy. If you enjoyed the video, please like and subscribe. Thank you for the support.